Here is a strange fact about the options market. Insurance against a stock market crash is almost always expensive, and everyone who prices it knows it. Right now, an index called Skew, which measures how dear crash protection is relative to ordinary options, sits near 150, in the upper half of its range for the past year. Meanwhile, the VIX, the market's everyday fear gauge, is resting in the mid-teens. Two dials, same market. One says relaxed, the other says crash insurance still costs a premium. That gap is not a glitch. It is a permanent feature of markets that appeared almost overnight on one specific Monday in October 1987, and it has never gone away since. This video is about that feature, the volatility skew. Why should you care about the price of insurance you may never buy? Because the skew is one of the cleanest windows into positioning that exists. When downside protection gets bid, it usually means large institutions are quietly paying up to hedge portfolios they cannot easily sell. When it goes flat, it can mean the hedges have already been monetized, or that nobody feels the need to carry them. And here is the early payoff of this video. The reason crash insurance always costs more is not that crashes are likely. It is that a crash is catastrophic for the specific people selling the insurance at the exact moment everything else they own is falling too. Once you see the skew as the price of correlated catastrophe rather than a forecast, a lot of strange market behavior starts making sense. The rest of the video builds that machine one piece at a time. To understand the skew, you have to go back to a world where it did not exist. Before October 1987, implied volatility, which is simply an options price expressed as an expected amount of movement, looked roughly the same across strikes. A bet on a big fall cost about the same, in volatility terms, as a bet on a big rally. Traders priced options with models that assumed market moves follow a tidy bell curve, where a one-day collapse of 20% is essentially impossible. Then came Monday, October 19th. The Dow Jones Industrial Average fell 22.6% in a single session, closing near 1,739, still the largest one-day percentage drop in its history. A mechanical hedging strategy called portfolio insurance, which sold futures automatically as prices fell, poured fuel on the move all day. No bell curve allowed for that day. Option sellers who had priced puts as if such a crash were impossible were wiped out or scarred. And when the market reopened for business in the weeks after, downside options were never priced the same way again. Out-of-the-money puts began trading at persistently higher implied volatility than upside calls, a lopsided pattern traders came to call the smirk. It has now persisted for nearly 4 decades. The question is why a single day would permanently change prices. 3 forces keep the skew steep, decade after decade. Force 1 is demand asymmetry. The natural order flow in index options runs one way. Pension funds, insurers, and asset managers own trillions in stocks. They buy index puts to protect those holdings, and many of them sell upside calls to pay for the protection. The dealers on the other side of that flow end up structurally short the puts everyone wants and long the calls nobody wants. A dealer who must warehouse that risk charges more for the thing everyone is buying. That alone tilts the surface. Force 2 is the seller's problem. Stock markets take the stairs up and the elevator down. Falls are faster and more violent than rallies, and in a real break, everything falls together. Correlation across stocks rushes toward one, so the person who sold you the crash put is losing on the put at the same time their other positions, their funding, and sometimes their employer are all under stress. Insurance against a correlated catastrophe cannot be priced at its actuarial cost. For the same reason, hurricane insurance on a coastline costs more than the average expected damage. The seller must be paid for the scenario where all claims arrive at once. Force 3 is the feedback loop, and this is the quant wedge of the whole story. A dealer who is short downside puts gets shorter what traders call gamma as the market falls, meaning their hedge requires selling futures into a falling market, which pushes prices lower, which raises the demand for protection, which lifts implied volatility further. Spot down, volatility up is not a coincidence in equities. It is partly manufactured by the hedging of the very insurance the skew prices. The skew, in other words, encodes this relationship in advance. It is the market's memory of the crash, plus its knowledge that the machine which turns falls into fast falls is still installed. None of this says a crash is coming. It says the market permanently charges for the possibility, because the people selling the possibility cannot survive giving it away cheap. So how do you rid this dial? SIBO compresses the steepness of the S&P, puts skew into the skew index. A reading near 100 means the options market is pricing almost no tail risk. The further above 100, the more expensive crash protection is relative to at-the-money options. Over the past year, the index has swung between roughly 132 and 162. and it closed near 150 in early July. Two patterns are worth knowing. Skew often steepens quietly after long rallies as institutions hedge gains while the spot market looks calm, which is why a high skew reading alongside a low VIX is less contradictory than it seems. And skew can actually flatten during a panic, because that is when put owners finally sell their insurance to monetize it. The people who got hurt by misreading this were usually sellers of tails who mistook a persistent premium for free money. The short volatility trades that blew up in past crises were, at bottom, bets that the crash tax was a market error. It is not an error, it is a price. The lesson is bigger than options. Prices in derivatives markets are not forecasts. They are the cost of transferring a risk from someone who cannot hold it to someone who must be paid to. The volatility skew is the longest running example, a permanent premium on downside risk, born on a single day, sustained by hedging demand, seller economics, and a feedback loop that is still wired into the market. Read it as a barometer of hedging pressure, not as a prediction machine. Next time index markets grind to new highs, watch what the skew does underneath. The spot price tells you what people think. The skew tells you what they fear. If you want more breakdowns of the machinery under the market, subscribe for the next one. This has been educational content, not financial advice.